Welcome back to Bonnie's Life, where we turn complex financial concepts into actionable insights that can transform your trading journey. I'm your host, Bonnie, and today we're diving deep into something that could literally save your financial future. We're talking about risk mitigation strategies for crypto trading, and trust me, after what we've learned from that incredible $125,000 to $43 million Ethereum trade, this conversation couldn't be more timely. Now, I know what you're thinking. Bonnie, that trader made millions. Why are we talking about risk? Well, here's the thing that most people don't realize. For every success story like that, there are thousands of traders who've lost everything trying to replicate those results. The difference between the winners and the losers isn't luck, it's not timing, and it's certainly not some secret strategy. It's risk management, pure and simple. Today, we're going to build your personal fortress against the chaos of the crypto markets. We'll explore the psychological traps that destroy even the smartest traders, master the art of position sizing and leverage management, and create monitoring systems that will keep you informed and protected. By the end of this episode, you'll have a comprehensive toolkit that can help you navigate the treacherous waters of crypto trading while protecting your capital. But before we dive in, let me share something that might surprise you. The European Central Bank recently published research showing that some crypto exchanges offer leverage of up to 125 times your initial investment. That means with just $1,000, you could control a $125,000 position. Sounds exciting, right? Well, it should also terrify you because that same leverage that can make you rich can wipe you out in minutes. Let's start with the most dangerous enemy you'll face as a trader. And it's not the market volatility, it's not regulatory uncertainty, and it's not even the technical complexity of DeFi protocols. Your biggest enemy is yourself. The psychological battlefield of trading is where most fortunes are lost, and understanding your own mind is the first step to protecting your wealth. Greed is probably the most obvious psychological trap, but it's also the most misunderstood. Greed isn't just wanting to make money, that's natural and healthy. Greed is when that desire becomes so overwhelming that it clouds your judgment. It's when you see a 50% gain and think, why not 100%? It's when you ignore your exit strategy because you're convinced the price will keep climbing forever. The trader in our case study could have held on for even bigger gains when their position reached $43 million, but they didn't. They had the discipline to take profits at $6.86 million, which was still a 55x return on their initial investment. That discipline, that ability to say enough, is what separated them from the countless traders who've watched their paper profits evaporate. Fear is greed's evil twin, and it's just as destructive. Fear of missing out drives you to jump into trades without proper analysis. Fear of loss paralyzes you when you should be cutting your losses, and fear of being wrong keeps you in losing positions long after you should have exited. The key to managing fear is preparation. When you have a solid plan and you've done your homework, fear loses much of its power over you. Then there's overconfidence, which is perhaps the most dangerous psychological trap of all. A few successful trades can make you feel invincible, like you've cracked the code of the markets. This is when traders start taking bigger risks, using more leverage, and ignoring the very principles that made them successful in the first place. Remember, the market has a way of humbling even the most successful traders. Confirmation bias is another silent killer. This is when you only seek out information that confirms what you already believe, and ignore anything that contradicts your position. In the fast-moving world of crypto, this can be fatal. You need to actively seek out opposing viewpoints and challenge your own assumptions constantly. Now let's talk about the knowledge gap, because trading without proper understanding is like performing surgery without medical training. The crypto market is incredibly complex and constantly evolving. You need to understand not just the basics of blockchain technology, but also market dynamics, regulatory developments, and the specific risks of different trading instruments. Market dynamics in crypto are unlike anything in traditional finance. A single tweet from an influential figure can move markets by billions of dollars. Regulatory announcements can cause massive price swings overnight. Understanding these dynamics and staying informed about macroeconomic trends, regulatory developments, and technological innovations is crucial for making informed trading decisions. Technical analysis while not a crystal ball, can provide valuable insights into potential price movements. Learning to read charts, understand support and resistance levels, and identify trends can give you a significant edge in your trading. But remember, technical analysis should complement, not replace, fundamental analysis and risk management. On-chain analysis is a unique tool in the crypto world that can provide insights unavailable in traditional markets. By analyzing blockchain data, you can see what large investors are doing, track the flow of funds, and identify potential market movements before they happen. This is particularly valuable in a market where information asymmetry can be significant. Now let's address the elephant in the room: leverage. Leverage is like a powerful sports car. In the right hands, with proper training and respect for its power, it can be an incredible tool. But give it to someone who doesn't understand its capabilities, and it becomes a weapon of mass financial destruction. The Bank for International Settlements published research showing that typical leverage in DeFi ranges from 1.4 to 1.9 times, with even the most active users rarely exceeding 2 to 3 times leverage. Our case study trader was using an estimated 20 to 30 times leverage, which is 10 to 15 times higher than what experts consider normal or safe. This should give you perspective on just how extreme their strategy was. If you're new to trading, start with low leverage or no leverage at all. There's no shame in this approach. In fact, it's the smart approach. You need to learn to walk before you can run, and you need to learn to trade profitably without leverage before you even think about amplifying your positions. When you do use leverage, understand its true cost. Most exchanges charge funding fees for leveraged positions, and these can eat into your profits over time. Factor these costs into your trading decisions and never use leverage to try to recover losses. This is a recipe for disaster that has destroyed countless trading accounts. Position sizing is arguably the most important aspect of risk management, yet it's often the most overlooked. This is the process of determining how much of your capital you'll risk on a single trade, and getting this right can mean the difference between long-term success and catastrophic failure. The 1% rule is a widely accepted principle in trading. Never risk more than 1% of your trading capital on a single trade. This might seem conservative, but it's the key to survival in the markets. If you have a $10,000 trading account, you should never risk more than $100 on any given trade. This ensures that even a long string of losing trades won't wipe out your account. Your position size should always be calculated in relation to your stop loss. A stop loss is a predetermined price at which you'll exit a trade if it moves against you. Once you've determined your stop loss, you can calculate your position size using this formula. Position size equals your total trading capital times your risk per trade percentage, divided by the difference between your entry price and stop loss price. The volatility of the asset you're trading should also influence your position size. For highly volatile assets like many altcoins, you should use smaller position sizes to account for the increased risk. Bitcoin and Ethereum might allow for slightly larger positions due to their relative stability, but even these major cryptocurrencies can experience significant volatility. Let's talk about exit strategies, because knowing when to get out is even more important than knowing when to get in. A well-defined exit strategy is your insurance policy against both catastrophic losses and the regret of missed profits. Always use a stop loss. This is non-negotiable. A stop loss is your safety net, the one thing that can protect you from a catastrophic loss. Never enter a trade without a clear stop loss in mind, and never ever move your stop loss further away from your entry price. This is one of the cardinal sins of trading. Just as you should have a clear plan for where you will exit if a trade goes against you, you should also have a clear plan for taking profits. This could be a specific price target, a trailing stop loss, or a combination of both. The key is to have a plan and stick to it even when your emotions are telling you to hold on for bigger gains. Before entering any trade, assess the potential risk-reward ratio. This is the ratio of potential profit to potential loss. A good rule of thumb is to only take trades with a risk-reward ratio of at least 1 to 2, meaning your potential profit should be at least twice your potential loss. This gives you a mathematical edge even if you're only right 40% of the time. Now, let's build your risk assessment and monitoring framework. Trading without a clear view of the risks you're taking is like flying blind in a storm. You need instruments, you need data, And you need a systematic approach to evaluating every potential trade. Before every trade, conduct a thorough risk assessment. Start with the macroeconomic environment. What's happening with interest rates? Is there recession risk? Are there any major geopolitical events that could impact markets? These factors can have a significant impact on crypto prices, especially during times of uncertainty. Assess market sentiment using tools like the Crypto Fear and Greed Index, but don't rely on them exclusively. Monitor news, social media, and other sources of information to get a complete picture of market sentiment. Remember, sentiment can change quickly in crypto markets, so stay alert. Keep a close eye on regulatory developments. Regulatory news can be a major catalyst for price movements in crypto markets. Subscribe to regulatory updates from major jurisdictions and understand how potential changes could impact your positions. For each asset you're considering, conduct both fundamental and technical analysis. Fundamental analysis helps you understand the underlying value proposition of the asset. Does it have a strong development team, a clear use case, a vibrant community? Technical analysis can help you identify trends, support and resistance levels, and potential entry and exit points. Consider the liquidity of the assets you're trading. Can you enter and exit positions easily without significantly impacting the price? Trading illiquid assets can be extremely risky, as it can be difficult to exit a position when you need to. This is particularly important when using leverage, as liquidations in illiquid markets can be especially brutal. Analyze the correlation between your potential trade and the rest of your portfolio. If you're already heavily invested in assets that are highly correlated, adding another similar position could increase your overall risk exposure without providing additional diversification benefits. After every trade, whether it's a winner or a loser, conduct a thorough post-trade review. What went right? Did you follow your trading plan? Did you manage your risk effectively? What went wrong? Did you let emotions influence your decisions? What can you learn from this trade that you can apply to future trades? Let's talk about platform selection, because where you trade can be just as important as what you trade. The platform you choose is your gateway to the crypto markets, but it can also be a significant source of risk. Centralized exchanges offer convenience and liquidity, but they also introduce custody risk. When you trade on a centralized exchange, you're entrusting that exchange with your funds. If the exchange is hacked or goes bankrupt, you could lose everything. Choose exchanges with strong security track records, proper insurance, and regulatory compliance. Decentralized exchanges eliminate custody risk, but introduce smart contract risk. While smart contracts are designed to be immutable and self-executing, they can contain bugs or vulnerabilities that can be exploited. Only use well-audited protocols with proven track records. Diversification isn't just about holding different cryptocurrencies. True diversification means spreading your risk across different asset classes, different strategies, and different time horizons. Don't put all your eggs in the crypto basket, no matter how bullish you are on the technology. Consider allocating only a portion of your investment portfolio to crypto trading. Many financial advisors recommend limiting crypto exposure to 5 to 10% of your total investment portfolio. This allows you to participate in the potential upside while limiting your downside risks. Within your crypto allocation, diversify across different types of assets. Don't just buy Bitcoin and Ethereum. Consider different sectors like DeFi, gaming, infrastructure, and emerging technologies. But remember, diversification in crypto is limited because most assets are still highly correlated to Bitcoin. Implement dollar cost averaging for your long-term holdings. Instead of trying to time the market perfectly, invest a fixed amount at regular intervals. This strategy can help smooth out volatility and reduce the impact of emotional decision-making. Security should be your top priority in the crypto world. The decentralized and irreversible nature of blockchain transactions means that if your funds are stolen, they're likely gone forever. Implement multiple layers of security to protect your assets. Use hardware wallets for long-term storage. Never keep large amounts of cryptocurrency on exchanges for extended periods. Enable two-factor authentication on all your accounts and use unique, strong passwords for each platform. Be extremely cautious of phishing attempts and never share your private keys with anyone. Stay informed about the latest security threats and best practices. The crypto space is constantly evolving and new threats emerge regularly. Follow security experts, read security updates from the platforms you use, and always err on the side of caution. Let's address the regulatory landscape, because compliance isn't just about following rules, it's about protecting yourself from regulatory risk. The regulatory environment for crypto is evolving rapidly, and staying compliant can help protect you from legal issues and potential losses. Understand the tax implications of your trading activities. In most jurisdictions, crypto trading is subject to capital gains tax, and you're required to report your gains and losses. Keep detailed records of all your transactions and consider working with a tax professional who understands crypto. Be aware of the regulatory requirements in your jurisdiction. Some countries have banned crypto trading entirely, while others have specific licensing requirements for exchanges and traders. Make sure you're operating within the legal framework of your country. Consider the regulatory risk of the platforms you use. Exchanges and DeFi protocols operating without proper regulatory compliance may face enforcement actions that could impact your ability to access your funds. Choose platforms that are proactively working toward regulatory compliance. Now, let's talk about building your personal trading system. This isn't just about having a strategy. It's about creating a comprehensive framework that governs every aspect of your trading activities. Start by defining your trading goals clearly. Are you looking for short-term profits or long-term wealth building? What's your risk tolerance? How much time can you dedicate to trading? Your goals should drive every other decision you make about your trading approach. Develop a written trading plan that covers your entry and exit criteria, position sizing rules, risk management protocols, and review processes. This plan should be detailed enough that someone else could follow it and make the same decisions you would make. Create a trading journal to track all your trades and decisions. Record not just the financial details but also your reasoning for each trade, your emotional state, and any external factors that influence your decisions. This journal will become an invaluable tool for improving your trading over time. Establish clear rules for when you'll step away from trading. This could be after a certain number of consecutive losses, when you're feeling emotional, or when market conditions don't match your strategy. Having these rules in place can prevent you from making costly mistakes during difficult periods. Let's discuss the importance of continuous education and adaptation. The crypto market is constantly evolving, and what worked yesterday might not work tomorrow. Staying ahead of the curve requires a commitment to continuous learning and adaptation. Follow reputable sources of information and analysis. This includes traditional financial media, crypto-specific publications, regulatory updates, and academic research. But be critical of your sources and always verify important information from multiple sources. Participate in trading communities and forums, but be cautious of hype and misinformation. These communities can be valuable sources of information and support, but they can also be echo chambers that reinforce bad decisions. Always do your own research and think critically about the advice you receive. Consider paper trading or using small amounts to test new strategies before implementing them with significant capital. This allows you to learn and adapt without risking substantial losses. Many successful traders spend months or even years developing and testing their strategies before trading with meaningful amounts. Stay humble and remember that the market can humble even the most successful traders. Overconfidence is one of the biggest destroyers of trading capital. Always be prepared to admit when you're wrong and to learn from your mistakes. Let me share some insights from leading experts in the field. Ryan Lee, chief analyst at BitJet, has emphasized that Ethereum and Bitcoin remain vulnerable to sharp swings on any shift in sentiment, particularly regarding Federal Reserve policy. This highlights the importance of staying aware of macroeconomic factors that can impact crypto markets. The Financial Stability Board, led by Klaus Knot, has warned that crypto assets are nearing a tipping point toward systemic risk. This means that the interconnectedness between crypto and traditional finance is growing, making risk management even more critical for individual traders. European Central Bank research has shown that leverage contributes significantly to crypto market volatility, with liquidation cascades amplifying price movements. This reinforces the importance of using leverage cautiously and always having proper risk management in place. As we wrap up today's deep dive into crypto risk mitigation, I want you to remember that successful trading isn't about making the biggest gains or taking the most dramatic risks. It's about consistency, discipline, and preservation of capital. The trader who turned $125,000 into millions didn't do it by gambling everything on a single trade. They did it through careful risk management, disciplined execution, and knowing when to take profits. The strategies we've discussed today aren't just theoretical concepts. They're practical tools that can help you navigate the challenging but potentially rewarding world of crypto trading. Implement them gradually, test them with small amounts, and adapt them to your specific circumstances and goals. Remember, the goal isn't to eliminate risk entirely. That's impossible in any form of trading or investing. The goal is to understand your risks, manage them effectively, and ensure that you can survive the inevitable losses that come with trading. As the saying goes, it's not about how much you make when you're right, it's about how little you lose when you're wrong. The crypto market will continue to evolve, new opportunities will emerge, and new risks will develop. By building a solid foundation of risk management principles and maintaining a commitment to continuous learning and adaptation, you'll be well positioned to navigate whatever challenges and opportunities the future brings. Before I sign off, let me leave you with this thought. In the world of crypto trading, your biggest asset isn't your capital, it's your ability to think clearly under pressure, to stick to your plan when emotions are running high, and to learn from both your successes and your failures. Protect that asset above all else. That's all for today's episode of Bonnie's Life. If you found this analysis valuable, please hit that like button, subscribe to the channel, and ring the notification bell so you never miss an update. Share this episode with anyone who might benefit from these risk management strategies. Your engagement helps us continue bringing you high-quality, in-depth analysis of the most important topics in finance and crypto. What are your thoughts on these risk mitigation strategies? Have you implemented any of these techniques in your own trading? What challenges have you faced in managing risk in the crypto markets? I'd love to hear from you in the comments below. Your insights and experiences help make this community stronger and more knowledgeable. Until next time, remember to stay curious, stay informed, and above all, trade wisely. The markets will always be there, but your capital is finite. Protect it, grow it carefully, and never stop learning. Thank you for watching Bonnie's Life, and I'll see you in the next episode.